What is going on, investors? Hopefully you guys are doing well out there. It is time to talk about AT&T Incorporation, ticker symbol T. Over the last year, the stock is down 9%. Over the last 5 years, the stock is down 36%. But right now, at the current time, this is likely not going to continue into the future. Talk about that on today's show. Right now, you're getting a 7.85% yield on this one, $2.08 per share. This stock, after reporting earnings today, is heading lower. And I think some of it has to do with some of the financials. We'll get into them. They had revenue of $41 billion. We saw a decline year over year of about 10% on that one. The guidance came in. It wasn't necessarily that great, wasn't necessarily that upbeat, but it was in line with what investors were expecting over at AT&T. Take a look at the revenues, the profits, the cash flow, the all-important debt on the balance sheet, and the interest expense that AT&T pays. And then we'll look at this from a technical perspective. What was interesting is when this company reported earnings, this stock was actually on a pretty nice little uptrend over the last month or so. Stock's gone from about $22. It was close to $26, $27 per share. But then what happened today is they reported earnings. And like I said, the initial reaction was actually positive. But then the CEO of AT&T opened his mouth about the Time Warner and Discovery deal, which investors thought was in place, thought they had a plan for it. But then the CEO opened his mouth and really caused a lot of investor confusion. And when you have a stock that already technically looks really bad from a fundamental perspective, not that great, it is probably the worst thing that the CEO can do is even pile on even more confusion onto that. The CEO came out in a press conference, in a conference call today, saying that the company, AT&T, has thought about doing a split off, which would basically give the company the option to actually, instead of awarding you, the shareholder of AT&T, the original deal planned for AT&T shareholders to retain a small portion of AT&T's parent company, the wireless business, the internet business, the business wireline business as well. And you are going to get a portion of the new company, which will be Time Warner and Discovery. You'll get some shares or some equity into that business. Well, the CEO opened his mouth today and for some reason floated the idea that they're actually thinking about doing a split off, which would basically mean that if you own AT&T shares, you will only be left with AT&T shares. And instead of awarding you shares in the new company of Time Warner and Discovery, they would actually take that equity and simply retire some of AT&T shares. Now, if you're an AT&T shareholder, that might benefit you to a certain degree. Obviously, reduced number of share count out there makes your equity stake obviously go up a little bit. The other thing that it does when we're thinking about AT&T is the fact that they pay a dividend per share. So obviously less shares outstanding would be beneficial from that cost going out the door. I just thought the CEO, John Stankey, laid just the stankiest comments on this. What the heck are you doing? You announced this deal months ago, and now you're starting to come out when this deal was supposed to be getting close to finalized. Now you're starting to talk about how it's being executed. No wonder this stock is down 7%. This guy's an absolutely freaking idiot. He should be fired the minute these companies split off, but my guess is he'll get an exceptional bonus package and probably walk away with millions. Now, let's move on to the fundamental part of the show, where revenues came in at $41 billion in Q4. That was a decline of 10.3% year over year. We talked about how shares were actually up pre-market 1.2%, and then this idiot CEO opened his mouth and for some reason clouded a deal investors thought was already set in stone. Investors already know this is a big deal. It is a complex deal. We understand that. We understand that these things take time, but we don't expect months later to now continuing to be talking about how this deal will impact shareholders. We already thought that was outlined when this deal was announced months ago. This is an example of how stupidity, incompetence, from executives can absolutely ruin an investment. And so we don't talk about it probably enough here on the channel, but in a lot of ways, you don't necessarily need to invest in good stocks. You need to invest in good leaders. And the CEO of AT&T is not a good leader. A good leader would have talked about this a long time ago, not dropped it on the laps of investors in a Q4 earnings call. Absolutely moronic. The guy should be ashamed of himself. And if the shareholders and the board of directors had any sack between their legs, they would try to fire this guy immediately. Now, let's get on to the AT&T income statement. Here's on our most recent quarter, our fourth quarter. Here's our operating revenues coming in at that $40.9 billion or $41 billion. Last year, you were at $45.7 billion. That's a decline of about 10.4%. Now, for the year end, you're down, let's just say 1.7%. You went from 171 down to this 168. Now, they did a nice job at AT&T controlling costs. When your revenues are declining, well, you better control costs, and they did a nice job of that, okay? They had declines on the broadcast programming and operations. Whether or not that's great, whether or not you don't need to be investing in those types of things. I've seen the ratings on some of the programs and some of the networks that AT&T owns, and quite frankly, the ratings have started to go into the tubes, and so maybe they need to do some better investment or start changing the program at some of these places. Now, the other things, we have other costs of revenues, those are down. Now, the asset impairments and abandonment, that's showing you that's down 98%, but this is kind of a one-time charge, or theoretically kind of a one-time thing, or something that doesn't necessarily reoccur every quarter. You had $16 billion in costs last year. You're down to just 188. So they realized that basically in the fourth quarter of last year. This year, you didn't have to do that. And then you've got depreciation as well. That decline, not necessarily a big deal. That is a non-cash card. So we get down to this total operating expenses down to about $35.6 billion. That shows you on paper it's down 36.8%, but just keep in mind the vast majority of this decline is actually coming from this asset impairment. You take this $16 billion and you minus off this 56, and you definitely lowered your operating expenses over at AT&T, but not quite by 36%, okay? Because when you factor in these other costs that are reoccurring, the costs did go down, but not as drastically as it sees here. Now, in terms of our operating income, so we have this basically $41 billion. We minus off all our costs, we get down to operating income of $5.3 billion. Obviously, when you had this massive asset impairment and abandonment, last year's operating income looks a heck of a lot worse than this year. This is a pretty normalized amount for AT&T. Now, they do pay some interest expense. We keep a very close eye on this because I'll show you how much debt this company has, and it's a massive amount, okay? But our expense on that debt actually went down year over year from $1.9 billion down to $1.6 billion. So AT&T's actually done a nice job of refinancing a lot of this debt and paying a lower interest rate on it. That's down 12%. For the full year, you're down about 13%. And that's a pretty major cost, okay? Look, for the full year, you paid $6.8 billion just in interest expense. That's not necessarily something to sneeze at. Come all the way down to net income, you earned about $5.3 billion. Again, we talked about how net income and operating income in last year's quarter was basically blown up by this asset impairment charge. And again, when you see asset impairments and abandonment, that is a sign of CEO and executive failure. This guy, John Stankey, clearly is not doing a good job. Clearly, okay? And if I owned AT&T shares, I personally would probably sell them because these financials don't paint that great of a picture, and you combo it with somebody that clearly is in over his head and doesn't know what he's doing, and it creates a recipe for disaster. And then what it also creates a recipe as a stock chart that looks like this, where a stock back in 2016 was up over $43, and it's been basically cut in half since that time. Now, let's move on to the balance sheet. Not that bad of a picture, okay? Last year at this time, they had just $9.7 billion in cash. Now they're up to $21 billion. My guess is when we looked at the operations, it's not a lot of that cash is coming from there. We'll see that from when we get over to cash flows. Now, in terms of our total assets, they ticked up a little bit. No big deal. We do have this long-term debt over here at $152 billion. That went down just slightly from 153 to 152. I will keep in mind this stock has a $188 billion valuation duration on it, and it has $152 billion in debt. They do have a lot more matured debt maturing over this course of this next year. So you have $3.4 billion, but you have debt maturing likely over the next 12 months of about $25 billion. So that would explain why the company has a little bit more cash on their balance sheet, because guess where that cash is likely to go? It's probably going to go, at least a portion of it, to pay down this debt that is due in the next couple of years. We'll see where they had to issue this debt, but I will point you to their licenses up here that went from 93 billion up to 113, like Verizon and other wireless providers in this space. In order to ramp up their 5G, they have to invest billions and billions of dollars. Now, we've got our year-end cash flows here. We pull down a net income of $21.5 billion. Notice that last year was negative, but again, most of that was due to that asset impairment. We get to add that back in here. Here it is at $18.8 billion. So you get a little bit cleaner view year over year on this cash flow statement. So we come down here to the bottom line of the cash flows, net provided by operating activities. AT&T earned $41 or nearly $42 billion in the most recent year on those cash flows. So while the net income number looks way better than last year, it was mainly due to basically executive stupidity and failure. And so that's why you had this big asset impairment and abandonment. And so year over year on the cash flow side, it actually paints a bleaker story. You went from $43 billion worth of cash flow down to about 42. Now, in terms of capital expenditures, those are basically flat year over year. About up maybe $900 million from 15.6 up to the 16.5. We've got the acquisitions here coming in big time at $25 billion. We've got a few other expenses here, but here's our cash used in investing activities that came in at $32 billion. Last year was quite a bit lower at 13. So you made this $42 billion operating the business in terms of cash flow. But then in terms of your investing activities, about $32 billion walked out the door. You did issue some debt here of about $21 billion. That's its short-term loans. Okay, that's not long-term debt. That's actually just short-term. They did repay about 7.5 of that, so netted out is looking at about $14 billion. They did issue some long-term debt at about $10 billion, but they repaid about $3.1 billion. So net, that's about $6.8 billion. They pay some other things, including a big old hefty dividend of about $15 billion. After you pay dividends, after you issue stock and issue debt, you have positive cash flows down here on the financing activities of $1.5 billion. That's where some cash flowed into this business, is because last year you spent $32 billion in those financing activities. So that's why your cash position is up considerably over the last year, is that you actually net after paying dividends and issuing and paying back debt, you actually walked away with $1.5 billion, whereas last year you burned through about $32 billion. Now on to the technical segment of the show, and it doesn't get a whole lot worse than this. Longer term, this stock is in a steady downtrend. It doesn't look like it wants to reverse, although more recently, this stock did find some bottoming price action down here at $22 per share. It rebounded all the way up here to 27, which was a kind of an area somewhere up there, was an area of support, area of resistance. That's why I have kind of a thin red line. When the lines are thin, it's kind of there, but it's a little thin, and the stock looked like it had some momentum, and it looked like to me it wanted to walk back to an area where I think is a little bit harder level of resistance. That's back up here at about $29 per share. You notice that the stock for many years traded in a very tight range from about $29 per share up to about $31 per share. That's a really tight range. That's where a lot of the price action in. More specifically, you could drop it down here at about $27 per share. Basically, for the last 3 years, the stock's been pretty tight between 26 and 31, although we had kind of a blow off top here back in 2019 with AT&T, but that whole trend has broken down. Take a look. We made some lows, lower series of lows, lower group of lows. This looked like on a major uptrend, and then look at this big red candle, and we're coming all the way back down to a small area of support down here at $24. If that level does not hold, look out below. More than likely likely, I think with this one, you're probably retesting the lows unless for some reason the executives can kind of clean up the mess that the CEO made when he started talking about this deal and kind of waffling back and forth on it. This is what shareholders are waiting for. Not only are shareholders waiting for this deal to be consummated, potential shareholders are waiting as well. Because look, you might want to have AT&T in your portfolio. You might want to have Warner and Discovery in your portfolio, but you might want to wait until this deal actually goes through, until the spinoff is completed, until you can decide if you want to be in AT&T or you want to be in Warner. But when the executive and the management are still trying to figure out how the deal is going to get done, that is just going to create more confusion about people in the stock and even more confusion about people are on the sidelines. That is why the stock is under pressure and likely will continue to be under pressure until this management gets their behavior together. That was AT&T stock. Hopefully you guys have a wonderful day. We'll be back again soon with more. Good luck with your investments.